Okay, welcome everybody to the seminar today, which is co-hosted by Southeast European Studies at Oxford, CSOX, with Boštjan, who heads it up, sitting there, and also by the Political Economy and Financial Markets Programme, which was founded by the late Max Watson. And in fact, this has been the first seminar of Plethora this term. We have today Governor Jazbec, and you were educated in Budapest and Prague, got your PhD in Vienna, and your area of expertise in your PhD was exchange rate behaviour under transition. You worked for many years as a consultant for the World Bank at the EBRD. Then you joined the executive board of the Central Bank of Slovenia, or National Bank of Slovenia, until 2008. Then you worked as a consultant for the IMF in Kosovo, and then since 2013, which is 2 years ago, you became governor of the Central Bank. So welcome, and you're going to talk to us about non-standard monetary policy measures in Slovenia.
Thank you. Thank you, Adam.
But before you start, I should say that you can have a podcast of your presentation, which will be in public domain. After that, the Q&A session will be under what's known as Chatham House rules, which means that no one, people can report what is said, but not attribute who said what. So just to make that clear, that essentially off the record for the Q&A, but on the record for the podcast. Thank you.
Thank you, Adam, for this kind introduction. I think I should thank, unfortunately late Max Watson for this opportunity to be here, and of course Gillian for getting me here. I have a little bit of stage fright because I always thought that only the smartest people come to Oxford. I couldn't make it while I was studying, so then I became the governor of this stressed country, and now here I am. So it's from the other side, which is also a great opportunity to at least share some thoughts on what is happening in Slovenia, and in particular on what is happening at the ECB. Wake up of all the recent policy changes in the scope that we're trying to aim at, and namely to regain the price stability, which is the main mandate of the ECB. So I'll talk for 40 minutes, I guess, and then we can draw upon some issues that mentioned in my presentation. But the bottom line is that, and this is also my concluding remark, is that the central banks are not the only game in town. It is still a lot of other policies that should be complementing what we are doing at ECB. And I'll try to draw this conclusion and line of reasoning through everything what is happening in Slovenia. Slovenia, in this respect, is a miniature creature of and then resembles, maybe in more pronounced effect, everything what, in my view, is happening in Eurozone at large. So I'll touch upon two main issues: non-standard monetary measures of the euro system, which is a rather general overview, and then of course the effectiveness of non-standard monetary policy measures in Slovenia. There were a lot of questions how the effectiveness of the non-standard monetary measures will be employed or will be put in action in different parts of Eurozone. And Slovenia is, as I can say, and I can jump to the conclusion, is the one where the direct effect of non-standard monetary measures is not directly visible. But this still doesn't mean that we cannot benefit from the monetary policy that is run by the ECB. Being member of the governing council of the ECB, of course, we do discuss the effectiveness of non-standard monetary policy measures, and as you can see in recent months, it's obvious that everything what we did in a period of last year is actually working. I mean, there is a price or inflation revival, to put it in a quotation mark. There are more positive outlooks today than we were faced with a couple of months ago, and this is particularly the purpose and the aim of everything what we introduced. So just to go a little bit through what we understand to be the non-standard. Non-standard tend to be everything what is temporary in nature, but however this temporality it's of course relative, and this is why we are deviating from the common understanding of the monetary policy that we understood to be in place prior to the crisis. Of course, it will be very interesting to see how the professors will put this and academics will put this in the textbooks, because most of the textbooks they do not really apply to what we really understand and how we understand the world around us. So the introduction of non-standard monetary policy measures were motivated to ensure the continued effectiveness, particularly of the transmission monetary policy stance, and in the circumstances where the financial system was subject to considerable stress. Just 2 weeks ago, when we all met at the IMF annual meeting, all our counterparties were singling out the success of Slovenia, and then we are now the positive story of what happened. And it's for me taking office in 2013 when everything was really in distress, and then when we escaped the foreign assistance literally through the needle eye. Of course, it is music to my ear, but it's far from being a success story. If anything, we would be a success story if we did introduce all these measures 5 years ago and not, or 6 years ago. But we were late, and then because we were late, we probably paid more for the resolution of the banking system, and I'll get to the point where I'll show you what the effect of what we did in particularly in December 2013, when we recapitalized the banks, and we literally put close to 11% of the GDP in the banking system only to stabilize it, and how that affected the almost overnight flip of the everything what others were thinking about Slovenia. So all of a sudden the outlook greatly improved, and today we are in the upper third of the Eurozone countries in terms of the GDP performance, and then all the forecasts are putting us in I would say a moderate, safe 2% growth in the next 2-3 years, which is better than the average of the Eurozone, but still far from something that we consider to be the potential output growth. So, however, we understand the non-standard or the notion of having non-standard monetary policy measures, we have to understand that those measures are there to complement the standard interest rate decisions. Of course, we are operating in environment of zero lower bound environment in terms of the interest rate, so there should be some other measures which complement this, and these are exactly the measures that in my view can be grouped in those these five groups, which also somehow chronologically took place since the outset of the crisis in 2008. They should be considered and understood as a package. So you cannot single out any of them and then just to observe the effect of any single of them, and I believe that they work as a package, and this is now of course there are no questions what to do with them. Is there any room for further negativity of the interest rates? Can we take out any other measure in any other of these groups? So what is the forward guidance really there for? And these are all the things which, of course, ECB was criticized to be late in introducing them. But if you look at really the series, chronological series of how we introduce them, it is just a work in progress. And I think that today, of course, markets every single time expects us the very next day when we introduce something to do more, and then there are always questions. So what's next? And I always say, look, do take a rest a little bit. I mean, leave us alone for at least for some time, because as we do know from the standard textbooks, there are always lacks in implementing. There are always lacks in recognizing. There are always lacks in conducting the monetary policy, and those lacks are in the case of ECB every single time exaggerated or by the markets in a way of okay, so what is next now? So the question now, which is popping out in recent weeks, is when do we start tapering the whole thing? I mean, we only got into the QE, so why should we really now think about the tapering at this point? And I have to mention this because my name is popping out because I did some conference. There was the one journalist who asked me, but yes, if you get to the price stability mandate, would that mean that you would stop the QE? And this is a very difficult question to answer. Yes, I mean, of course, we are there to our mandate is to provide the financial stability, price stability in a range below but close to 2%. So if we reach this mandate, then of course there will be probably at least the decision on how to proceed further. So, but it is too too early to talk about this at this moment. So it is really the play that not only the European Central Bank, but all other central banks got into it. So the financial markets are just more developed today. They're more integrated today, and of course the nature of the play is a bit different than 10-20 years ago. So in this respect, this is also something that we discussed today on the train to Oxford. Is what is the potential use of competitive devaluations today, and how to understand the potential competitive devaluations of certain countries today in light of a different nature of the financial markets. As 10 years ago, you might use the competitive devaluation. You might buy. You might be able to buy a couple of months, maybe a year of competitive advantage in this respect. But today, I believe that those things are just much faster, particularly because the nature of the central banking and the nature of the financial market completely changed. So these are. I'm not going through all the measures that the ECB employs or employed at a certain point. But what is really interesting is grouping of those non-standard monetary measures in three phases. So it was the first phase pretty much from the beginning of the crisis to 2008, 2010, when we had to face the liquidity crisis. There was this liquidity crunch after everything what happened in US, and then it was flown over to Europe. Then it was the phase two, when there was this serious fragmentation and sovereign crisis, pretty much from the mid 2010 to 2013, and then of course the third phase, which we started this year with increasing monetary stimulus and for enhancing transmission mechanism and securing price stability. And this all three phases add up to something which today is commonly understood as the ECB policy. So for me, I cannot really single out any instrument and say, okay, this instrument works, this instrument doesn't. It always have to look at it from the complementary point of view. This is the chart that I'm grateful to my chief economist Bishwait Banerjee, who is also the Oxford alumni, and he came up with this nice chart, and I also thank him for preparation of this presentation, and I think this is really comprehensive look at what the non-standard monetary measures really are. They're grouped by in two-dimensional system by all the listing of all the measures, which then generate the whole package, and also by phases. And you can see the also importance. What strikes me and what is very interesting, for example, in this chart, and then if you look at it back in group 4, there's this interesting thing which is also related to the communication of what the central banks are really doing. They're communicating to the markets and then to the public. It's the OMT, outright monetary transactions, as you probably know. They were never implemented, but the effect was visible and still visible. And this is the way the central banks principle operate. We communicate. We tried markets to understand us, the public to understand us. And this is part of the story, which in this chart is still there, although there is this peculiarity that OMT was never literally introduced, but the effects were seriously visible, and they're still visible today. So the financial crisis particularly impaired the channels through which the central banks, ECB in this respect, was normally transmitted to the economy and consequently to the prices. As mentioned already, there was serious fragmentation. There still is the eurozone fragmentation in this respect. So the efficiency of the monetary transmission is or was impaired, and then some of the measures aimed at improving this efficiency, and together with liquidity and the lowering of the market tensions, of course, the whole package of non-standard monetary measures is there to affect the market expectations, and of course forming the accommodative monetary policy stance, with the only aim to bring the price stability in the mandate of the ECB, namely to get the prices back to close but below 2%. So the transmission mechanism in times of crisis is depicted here. It is of course there are always questions. Did the ECB intentionally affect the exchange rate, for example? And this is, I have to say, and I have to boldly say that was never an aim. It is just the consequence of everything, because that would particularly when I mentioned that during my studies and in my early days of research, I was particularly interested in for example, re-exchange rate determination in transition economies, and it was I always found it very strange of taking the exchange rate as a policy instrument, because for me exchange rate is just one of the equations in a very complex set of equations. So you take one and fix one, and then you have to deal with n-1 equations in a very accommodative and very flexible system of equations. So for that reason, I have to say and admit and publicly say that there was never aim to affect the exchange rate. If somebody from the public, from the audience, can tell me what the exchange rate will be at the end of the year. Please share this information with me, because that's something that I think we should all better read the horoscopes, because then they're much better in predicting what's happening. And I'm Aries, by the way, so maybe you could look at what is happening there. So the thing is, this set of measures that were introduced by the ECB really affected the market is I think best seen in this chart. You can see the phases, the first, the maintaining the liquidity, and then particularly with the introduction of VLTRO, very long-term refinancing operations, the liquidity in the system substantially increased, and then, as you probably remember, the size of the balance sheet at the end of 2012 is also an aim of the quantitative easing that the ECB is conducting today, with this prolongation of buying roughly 60 billion a month up to September 2016, only in order to bring the balance sheet back to the levels at the end of 2012. And then there were a lot of speculations how President Draghi introduced that, and then how we're gonna do it. I can tell you from the Slovenia point of view, we are by capital key one of the smallest member of the ECB, and then by capital key we need to buy roughly 200 million a month, and it works. I mean, although there were a lot of uncertainties from the market side, from our side, it works. We are monthly buying the approved or required sum of the bonds in this respect, and it is the same goes for the ECB. So, but how this set of measures really affected the market conditions, you can see that the yields were seriously and substantially brought down, and that was particularly helpful in case of Slovenia. Though we had our internal problems in 2013, but those of you who come from investor side, you know that we were close to 7% on 10 years bonds in fall of 2013. While today we are around 1, below 1, which is enormous achievement in a time span of less than 2 years in this respect. Of course, we did this recapitalization and stabilization of the financial system, but the monetary policy of the ECB helped enormously in bringing down the levels. Now, for that reason, we are still on the positive side. So we are, in this respect, still very interesting for investors, because we still are paying higher than all the others, but this is probably the sweet problem that we are facing today. So, but what we can see, and then when I'll show you what happened in Slovenia was really that most of this increased liquidity in the system, and particularly in Slovenia, was used to deleveraging of the financial system. So everything what was overshooted before the crisis and what the banks brought on their balance sheets were then repaid through the use of relatively lax monetary policies. So you can see the different behavior of different countries, and the bold black line is Slovenia, and then you can see that from really end of 2013 we were able to finally get it to historically low levels, partly because of the ECB policy, partly and substantially because of everything what we did, and then everything what now I've been called to the parliament all the single time and then explained them that it was good what we did in 2013. Of course, for politicians it's difficult to understand that sometimes spending the taxpayers' money for the right purpose is a good thing, because and we've counted. I think since I took the office, I think I was in the parliament already 17 times, which is once a month, pretty much. It's nice. I mean, it's at least nice for my kids because they can see me on TV all the time. And it's, but for all others, it's particularly it's really exhausting. So the reactions on the different announcements, and particularly on the purchase, the white program, are seen here. Of course, as I said, communication really matters, and this is where the coining of the term forward guidance really came into place. I think if nothing else, the lessons learned from the crisis are that you have to communicate more, and you have to communicate effectively and consistently. And this is something that nobody can criticize the ECB for. It is a very consistent way of communicating, and this also helped the bringing down or stabilizing the markets, though the immediate effect on inflation expectations was not so visible, but it is something that at least recent months is building up. So for all of you who might raise the question, so what's next? I would tell you, look, wait a little bit more, because there are only 2 months since we really introduced the last part of the package. So that much being clever on what's happening at the ECB. So let's move to Slovenia, which is something that might not interest you as much as the part on the ECB, but it's there. So what we see in Slovenia is we have almost textbook example of creditless recovery. We have the positive economic growth, we have increased savings, but the banking sector itself is still contracted. We still have a negative credit growth, though much less than in the previous years. And even if you measure it on a month-to-month basis, you can see some positivity in the changes. But the thing is that what happened during the crisis in Slovenia is that the growth is driven by two main generators. One is the export sector, but Slovenia exports over 70% of the GDP, close to 75%, and more than half of the exporters are not using the financial services of domestic banking system anymore. So they switch to foreign financial services because the Slovenian banks had troubles with themselves for too long, and then that was the one switch, which is in a way good because this isolates the domestic problems a little bit, but then on the other hand means that probably in medium if not long run, we will see drastic changes to the nature of the Slovenian banking system, meaning the number of the banks will have to reduce, the consolidation process will have to take place. But you know, the Slovenia is a 2 million inhabitant country with 35 billion euros of the GDP, and we have 17 banks. So the understanding that the private banking is really there. I mean, you almost know your person on the counter because there are so many of them. So it was really personalized approach to. But jokes aside, it is the process that will probably take place. And then the second generator of economic growth in Slovenia is that we finally learn how to use others people's money. The utilization of Euro funds tremendously increased in last year. So we are building the soundproof fences along the highways, which are enormously eyesore, but obviously affect the economic growth. And this is something that is generating the growth. Of course, we would like to get the credit revival back, but it's very difficult because, as I'll show you on the next chart, everybody's saving in Slovenia, saving for the rainy days. I mean, the corporates are saving and piling the liquidity. The households are piling the liquidity, and we have the current account surplus. Current account surplus in a small country, exporting a lot, of course helps, and then helped us in the whole process of deleveraging. So a substantial part of the current account surplus went to the banking system. And Slovenia is often cast as a country with very little foreign direct investment. So in terms of foreign direct investment compared to all other countries in the region, is less compared to the others. But then in total volumes of foreign capital that got into Slovenia, we are on a comparable basis. Why? Because most of the money, the foreign capital that came in Slovenia, came through the banking system. And the banking system is substantially state-owned. So, of course, at the end of the day, there were taxpayers who had to pay for all the free lunches and the mistakes that we did in the past. So, and then what the banks brought on their balance sheets prior to the crisis, they had to repay during the crisis. So the current account surplus was and is mainly used for deleveraging. Then on the other hand, we have households, relatively indebted, the very little indebted households compared to the Eurozone. And this is also partly the legacy of the transition process that we had in the beginning of the 90s. We had a massive privatization of the housing fund. So Slovenia, I think, is after Ireland, and one of the top in terms of the private ownership of the housing fund. So there is no room for new credit revival in terms of the mortgage market. It is almost a shame if you don't own your own apartment in Slovenia. So now there are politicians coming on TV saying, yeah, but what about young families? They deserve to have apartments. But I mean, go and work first, and then maybe somebody should. But it's a political question again. Of course, with the economic consequences. So it is very difficult how to turn and how to bring all this money from the households back on the market, how to increase the private consumption. The Minister of Finance, of course, has a big plan of getting this money on the market. But then I asked him how he would do it. Would he come and knock on my door and force me to spend my savings to buy something which I don't need? And then his answer was he didn't really know how to do it. So it's a little bit difficult how to get the private consumption back. Of course, if there is no certainty in the economy, and then the certainty in the economy we only established with recapitalization in 2013. It takes some time before the confidence, the market, consumer confidence comes back on the market. Then the second thing is the households are also the corporates are also piling liquidity, but this is not again the case only in Slovenia, but also in other countries. You know that in 2014 there was this neat excuse for corporates of piling or not piling up the liquidity because nobody knew the results of the comprehensive assessment, whether the banks would need more capital or not, and these things just need a little bit more time. In case of Slovenia now, whenever we have discussions and talk with international financial institutions, they all come and say, yeah, but I mean, everything is too slow, but it's only 15 months since we did the recapitalization of the banking system. So it takes a little bit more time in reality in particular for policymakers to implement the changes and in particular to see the changes that were implemented. So the contraction of domestic loans in Slovenia still persists, and that's why I said that it is domestic creditless, but with a foreign assistance in terms of supporting the exporters. And you can see in this chart how the liquidity was used, the liquidity that were generated by the European Central Bank was used in Slovenia particularly in the times of the when everybody expected that Slovenia would really ask for the program from the beginning of the middle of 2011 up to the end of 2013. The banks were just sitting in liquidity because there was so much uncertainty in this respect, and then they were seriously using the VLTROs and all other instruments introduced by the ECB, and then only at the end of 2013, beginning of 2014, this was released, and then most of the also the leveraging process took place through those measures. The loan to deposit ratio also decreased, and it is this chart shows that there were the banks on the majority of the foreign ownership which had the highest loan to deposit ratios, which is not only the case of Slovenia, but the rest of the Southeast Europe, where mainly foreign banks' presence dominates in the banking system. And then what happened in 2013, 2014, when deposits started to come back to the system, and we have a positive deposit growth, but particularly in foreign-owned banks. So what happened was that we realized that foreign-owned banks were channeling those excess generated by deposits to their mother banks. So Slovenia is one of the very few, if not the only country, that introduced the macroprudential measure, which works on the lower bound of the spectrum. So we introduced the gross loan to deposit ratio, meaning that for every euro of increased deposits, banks had to issue 40 cents of loans, or 40 cents of increased liquidity buffer. Of course, the foreign banks didn't like it too much.
So this is one of your own measures.
This is one of our own measures, which is still in a national domicile in this respect. And then if you really look at the latest European Systemic Risk Board report, you would see that Slovenia is the only country introducing the measure on the lower bound. Everybody else is taking the measures on the upper bound, meaning that they're trying to contain the credit growth, while we're trying to do some impulse through the macroprudential measures. As you probably know, the macroprudential measures are known to be a little bit of asymmetric. They work on one side, but we are trying, and then so far we are proving right to work also on the other spectrum. But the history will tell whether we are right or wrong. But for the moment, we are busy spending time on finding the instruments, which is also something that came as a collateral or as an externality out of the non-standard monetary measures. The whole area of what the macroprudential really means. Macroprudential is still could be a national tool that is partly used for supervisory purposes, but also for complementing the monetary policy issues. And this is still the area that is a little bit of uncharted waters in this respect, not only in Slovenia, but that mainly generally in Eurozone. And this is something that a lot of attention is being put to. So we got now to the much safer levels of loans to deposit ratios today than they were before, but still far from some other countries which just had enormous loans to deposit ratios, and of course the main source of, or one of the main sources of the financial crisis. So, but the thing is that accommodative monetary policy did not have a direct effect on the lending rates, and that was particularly because of the general macroeconomic situation in Slovenia. We were constantly punished by relatively negative outlooks of the credit agencies during the or before we did the recapitalization of the banks in 2013, and only after that the lending rate started to go down. That is also important in terms of what might happen to the banking system at large. Why? Because the profitability of the banks not only in Slovenia but generally in Eurozone, is a little bit jeopardized by the size. We just have too many banks in Eurozone, and then size matters in this respect. I mean, if in any aspects of life size is really a question, then the size matters in the sense of the banking. Economies of scales should be thoroughly taken advantage of, and then for that reason I believe that there will be at least in Slovenia developments with an aim to reduce the number of the banks. The first moves we already did. We put 2 banks in liquidation in 2013. We're slowly coming to an end of that, and we will probably draw the license in the following months, and then to finally get them out of the market. Then there is a merger in the mid-range banks. So there is a process taking place right now, and I believe that will also affect the framework or the scape of landscape of the European banking system in this respect. Then we are constantly asked about the level of NPLs in Slovenia. Yes, they were high, but they are not so high anymore, and that they're comparable to something that is called in general the European average. The massive reduction of NPLs was done with the transfer to the bad asset management company, the bad bank, the Slovenian bad bank, that the government introduced in 2013. There are two main events. The first was, of course, the granting of the state aid to 2 banks in 2013. Then we had to wait for another year to get the state aid for another 2 banks, and those approvals by DG Comp, by European Commission, then substantially decreased the level of NPLs. Of course, NPLs are common in all distressed countries, and they're very difficult to deal with. And particularly in European context, if you look at the last global financial stability report of the IMF, there is a very nice chart comparing the legal environment in US and in Europe, and you would see that in the US is much easier to do the write-off than in Europe, and this also a little bit prevents the faster resolving of the NPLs. In the case of Slovenia, of course, that is also a problem, but we are dealing with it, and it's really round-the-clock exercise that the banks, the central bank, the government is trying to just put in the higher gear, because what is also very important is that banks that have NPLs are just not crediting. I mean, those with the clean balance sheets are much better in creating new credits than those who had the NPLs on their balance sheet. So that's also something that the international evidence, which in this sense confirms everything what we're trying to put a lot of efforts on in Slovenia. So the credit standards in Slovenia, banks are behaving better than Pope in Vatican. It is after the crisis, it's always difficult to expect the banks to get in a different mood and different attitude overnight. Of course, nobody wants to repeat the mistakes from the past, and particularly from the very recent past. And this is not only the case of Slovenia, but the case of also some other countries, particularly in the region, and this is also something that probably is worth exploring a little bit further. The countries with a little bit less developed financial markets, so let's put it politically correct, with the shallow financial markets, with not many financial instruments, are in a bit worse situation than countries with more developed financial systems. Why? Because the banking is still based on tangibility of the collateral, and you have to provide some collateral to get the credit. But what is the only tangible collateral in our countries or in the countries with less sophisticated financial markets? It is only the trade credit, and it is only the real estate. And then when you try to get the credit revival, you simultaneously either generate the bubbles on the real estate, or you run enormous credit account deficit, because there are no other tangible collateral in the economy. And the further you go in the spectrum of financial market development, the bigger the problem is. Look at for example, the countries of former Yugoslavia, where all the banking system were or are foreign owned based. They had rather dysfunctional judicial systems, and the only tangible assets are real estate and trade credit. When I work for the Central Bank of Kosovo, I mean, Kosovo is the least developed country in Europe. The banks were constantly keeping their liquidity abroad all the time, so there was enough liquidity. But then you went to and asked the bankers why they don't credit anymore. They say there is nothing we can collateralize anymore. There is no room for us except if you start generating the bubbles. But then there is a problem of repeating exactly the mistakes of the previous crisis. This is something that is also worth exploring further in light of European capital market development, because this might become the common denominator for also other distressed economies that might find the way out of simply putting lack of tangible collateral. As I said, it is still something that needs a little bit more evidence from data. But I can tell you, at least from two countries, Kosovo and Slovenia, that was mainly the case, tangibility of the collateral. And then I can also tell you this. I mean, the whole. Some of the instruments, and this is now coming to the conclusion, some of the instruments introduced by the ECB do not work in Slovenia because we don't have ABSs and we don't have the cover bonds. Why don't we have them? Because we are too small. Size matters again. So it is the volumes of potential ABSs and cover bonds are just too small to be cost efficient to issue them. So we are exploring the ways of maybe copycatting something that Italians did with the mini bonds, for example, because the volumes, hundreds of millions, are too small for being cost effective in this respect. So we cannot really play part as a small economy, and it's not only the case of Slovenia, but the case of other small Eurozone countries, because we don't have ABS, we don't have the cover bonds. So this is something that the direct answer to the question, do non-monetary standard monetary policy measures work in Slovenia? Not completely, not entirely. Why? Because there are some parts which we cannot use. However, we are benefiting from the second round effects. I mean, if Germany is doing well, we do well because we export. Germany is the biggest trading partner of Slovenia, so if they do well, we do well. And this is something which, of course, might call for these theories of dependence, codependence, unhealthy theories. But at the end of the day, it really what matters is the overall picture. So my answer to the non-standard monetary policy measure issue is. They work also in Slovenia, not in the direct round, not through the direct effects, but mainly through the second round effects. Why? Because if you look at this slide, half of all Slovenian bonds are held by non-residents, meaning that now when the Bank of Slovenia is buying bonds, there are mainly the foreigners who are benefiting from our purchases, and not directly the Slovenian banks, because Slovenian banks were relatively small or smaller than the non-resident investors or holders of Slovenian debt. So for that reason, we try to work on further restructuring of the enterprises, deleveraging, particularly improving the governance practices. It is difficult to change the mindset, the cultural mindset in this respect in economy, which substantial part of the economy is owned by the government directly, particularly in the banks, where 60% of the banking industry is state-owned. That's why the further privatizations are necessary, but not sufficient to the whole process of changing our economies to the fully fledged market economy. And of course, the durable fiscal consolidation, and this is something which then also calls for something which today is known as the Juncker plan, and this is something where I can conclude with what I started with. The central bank, the ECB, in this respect, is not the only game in town. So other policies need to be implemented to complement something which were generated by the ECB. ECB, in this respect, you know that if you read the comments, but 6 months ago, there was a lot of criticism on ECB QE, that it was generate the moral hazard, that some reforms might be delayed. Yes, I mean this still might be true, but the thing is that on the other hand, somebody should look at the positive side. ECB created an environment where implementation of structural reforms might be less painful than otherwise, and this is something that other policymakers should really start working on seriously, and then trying to complement what the ECB generated with the whole set of the measures which only aim was to, and still is, to bring the price levels in the scope of the ECB mandate. So with that, I would conclude my presentation. Thank you.
Well, thank you very much.